The candle range theory is a trading approach that, when understood and applied correctly, can dramatically improve your performance. By the end of this explanation, you will have the tools needed to recognize and use this concept within your own trading strategy. With that said, let's get straight into the explanation. As the term itself implies, before analyzing charts, we must first understand the underlying theory. Every candle displayed on a chart represents a visible range or movement of price. In simple terms, a candle that appears on a higher time frame contains within it a series of price movements that occur on a much lower time frame. Looking at the structure of a candle, we know that each one consists of an opening price, a closing price, a high, and a low. Although we see it as a single candle on a chart, regardless of the time frame, if we zoom into a lower time frame, we will observe the same price action expressed in more detailed movements. This internal movement is known as the lower time frame range that exists within a higher time frame candle. It is also important to remember that CRH stands for candle range high, while CRL stands for candle range low. Their significance will become clear shortly. Another crucial idea to understand is the power of three concept. The power of three describes how market movement flows. There are three distinct phases in this flow. The first phase is accumulation. Accumulation refers to a period of ranging price action, where the market moves sideways. During this phase, both market makers and retail traders often place pending orders with relatively small volume. This is likely something you've heard mentioned by other traders. Many traders struggle to grasp this idea, so let's break it down as simply as possible. Accumulation is nothing more than a preparation phase before a significant price move takes place. The second phase of market flow is manipulation. Manipulation represents the initial breakout from the accumulation range. However, as the name suggests, this move is often deceptive and designed to trap traders into taking the wrong positions. You might wonder why traders fall into these traps. The reason is that trading is inherently competitive. For some traders to profit, others must lose. Manipulation exists to take advantage of traders who cannot correctly read or interpret market movements. The final phase of market flow is distribution. Distribution is the move that occurs opposite to manipulation. For example, if manipulation pushed price upward, distribution will most often unfold to the downside. These three phases of market behavior are also commonly observed in session-based trading strategies. For instance, the Asian session often moves price sideways, forming an accumulation. Then the London session breaks out of that range either upward or downward, creating manipulation. The manipulation created during the London session often sets the stage for the New York session to drive price in the opposite direction of the London move. This is a pattern you have probably noticed many times before. Still, it's important to understand that this sequence does not occur every single day. In some cases, the Asian session may already be distributing price, followed by the London session moving sideways in accumulation. This scenario is uncommon because London is typically a high-volume session. Most of the time, London establishes or invalidates trends rather than remaining range-bound. When this uncommon structure does appear, it usually signals preparation for the New York session to initiate a manipulation move and restart the entire cycle. There are two scenarios to consider, and we will begin by explaining the bullish case. The candle range theory model generally focuses on a sequence of multiple candles on a higher time frame. Let's break down how this sequence works. The first higher time frame candle establishes a lower time frame trading range between its high and its low. The second higher time frame candle then sweeps liquidity from the first candle by extending a wick beyond its range. The final candle in the sequence breaks out in the opposite direction of that initial sweep. In this case, the first break is a liquidity grab below the candle range low. As you can see, this structure closely mirrors the power of three concept. It still consists of accumulation, manipulation, and distribution phases. In this explanation, I've illustrated the CRT using three candles. That said, it's important to understand that CRT is not limited to only three candles. Most of the time, it forms across a series of multiple candles. The key idea is that the same structure continues to repeat. For example, consider a situation where multiple candles form, with the first candle acting as the CRT reference candle, while the following candles fail to break either the high or the low of that initial CRT candle. This is not an issue, nor does it invalidate the analysis, because we can clearly observe that the manipulation break toward the candle range low occurred a few candles later. In addition, after the manipulation takes place, the distribution or accumulation phase does not need to immediately move strongly in the opposite direction. In most situations, price will gradually transition toward that direction over several candles. The same logic applies when the break happens in the opposite direction. If we identify a CRT model candle and price initially breaks the candle range high through manipulation, then our focus shifts towards sell-side opportunities targeting the candle range low. The CRT model and its pattern can form repeatedly in the market. However, there are moments when it can produce false signals. To avoid falling into these traps, it is essential to recognize and understand high-probability CRT setups. One of the most effective ways to improve the quality of a CRT trading model is by ensuring that the main CRT candle is located near or directly at a point of interest or a key level. As we already know, points of interest and key levels are essentially the same concept. These include areas such as order blocks, supply and demand zones, fair value gaps, and imbalances. Levels where the market is statistically more likely to react with strong volatility. We can further enhance the quality of a CRT setup if the pattern forms during specific hours. Keep in mind that these times are based on the New York time zone. While timing is not a strict requirement, it does increase the probability of a successful trade. The more conditions that align, the higher the overall quality and probability of the setup becomes. With that in mind, let's move to the charts and examine how the candle range theory is applied in practice. Typically, the analysis begins on a higher time frame. In this example, we start with the 4-hour chart. Initially, price made a move to the downside, followed by a corrective pullback to the upside. This pullback breaks an internal lower high and creates a new internal higher high. Since the prior internal structure was bearish and the microstructure shifted into a bullish trend, we get an internal change of character to the upside. From there, price respects an uptrend structure defined by higher highs and higher lows. For instance, we can observe a liquidity sweep where swing lows were taken. However, price failed to continue lower and instead rejected sharply to the upside. This is exactly where traders need to be cautious to avoid getting trapped. Eventually, price continued following the higher time frame macro uptrend. At this point, we also receive a bullish change of character on the external structure. This means both the internal and external structures are now aligned in the same bullish direction. By simply observing price action, we can already gain valuable insight into how the market is behaving. This helps us determine the higher probability direction in which price is likely to move. When we analyze basic market structure, we can see another push higher followed by a pullback lower. Understanding swing level formations and how they apply to market structure is critical. When we identify a higher low, we immediately recognize that the market is in an uptrend. In an uptrend, our primary focus should be on long buy positions. After all, why trade against the trend? Why make things more complicated than necessary? We also see a final push to the upside, forming a new higher high and confirming a bullish break of structure. As we move into the most recent price action, we have clearly established that the market is trending upward. The last candle printed around 5 a.m., which aligns with the time window we previously highlighted as important. On the 4-hour time frame, the next candle is the 9 a.m. candle. This candle is highly aggressive, signaling that large positions were entered with significantly higher volume compared to what we had seen before. This candle also sweeps liquidity from a support level that becomes more visible on lower time frames. Such a strong move often causes traders to believe that the market has shifted into a downtrend. As a result, these traders begin entering short positions, expecting price to form lower lows and lower highs, essentially anticipating a new downtrend structure. The issue with these traders is that they lack patience and allow emotions to drive their decisions. Now let's observe how a patient trader behaves by waiting for a few more candles to develop. Experienced traders recognize the slow, ranging behavior near the highest price levels on the chart. This movement is nothing more than accumulation. As mentioned earlier, accumulation is a sideways price range that prepares the market for a large and decisive move. And what usually follows an accumulation phase? A manipulation. What if that large bearish candle is actually the manipulation itself? If we apply the power of 3 together with the candle range theory, and factor in the time at which this large candle printed, we can mark its liquidity levels. The first liquidity target is the candle range low, which was taken out first, while the same CRT main candle also defines a candle range high. This strong, impulsive move created an imbalance in the market. You can clearly see the empty space on the chart, an inefficiency that price will eventually revisit and fill. Since the manipulation initially occurred by breaking the candle range low, our expectation is for price to rebalance and distribute back toward the candle range high. Because of this, our bias shifts toward looking for long buy opportunities. To refine the entry, we drop down to a lower time frame, such as the 30-minute chart. When we analyze the recent price action, we can see that starting from this specific candle, price initiated a reversal to the upside. Prior to that candle, price was trending downward on this time frame. After the reversal candle printed, the market began to form internal higher highs and higher lows. If we treat that candle as a demand zone, and considering that price is rapidly returning into that demand, we can look for long buy entries near the top of the demand area. The stop loss can be placed just below the demand zone, or for a more conservative approach, below the most recent swing low on this time frame. In this scenario, we are targeting more of a swing-style trade. For take profit, a logical target would be the candle range high. That said, in my personal view, aiming for the full move creates an unnecessarily high risk-to-reward expectation. A 1-to-4 risk-to-reward ratio is more than sufficient, even if the setup has the potential to reach 1-to-8 or higher. Avoid being overly greedy. Essentially, what we expect to see is the formation of an uptrend structure. The key objective is pushing price higher after the candle range low has been manipulated. So let's allow price to play out. Trade closed, take profit reached. The CRT model can be slightly more challenging because, although it aligns with the higher time frame trend, in the short term, we are often trading against the immediate move by timing pullbacks. This is really the only difficult aspect of the strategy. Everything else about the approach is quite mechanical and far less subjective. It comes down to recognizing repeated patterns that appear again and again once you train your eye through consistent practice. Looking at another chart during a backtest, we can see that this market initially moved sideways, consolidating both above and below key levels. Eventually, that consolidation broke to the upside, creating a new higher high, followed by a pullback that formed a higher low. Price then broke above the new highs again, continuing to form higher highs. The first high that was broken out of consolidation represents a bullish internal change of character, as it is the level that shifted the market into an internal uptrend on the microstructure. From there, we see higher lows forming as discussed, followed by a bullish break of structure after the second internal high is taken. Shortly after, price continues to print consistent higher highs and higher lows on the lower time frame, clearly defining an internal uptrend. However, our primary focus remains on the macro structure. We define the macro, or external structure, by marking the major swing points. For example, starting from a higher low, price formed an external higher high, then another external higher low, followed by a strong push upward that created new macro highs. After that, price pulled back, with the pullback holding above the previous one, and then delivered a final impulse upward. This impulse establishes the most recent external bullish break of structure visible on the chart. With this broader analysis complete, we shift our attention to the most recent price action. We already know the market is in an uptrend, and we can also see that there were no major liquidity sweeps or traps. Price moved higher in a relatively clean and controlled manner. If the trend continues, we would anticipate a pullback to the downside, followed by another push upward, maintaining this type of bullish structure. Now, if we look closely, we can see that a large candle printed at 5 a.m., a time we previously highlighted as important due to the typically higher volume. This candle often represents the manipulation phase when applying the power of three concept. Using the candle range theory, we mark its liquidity levels, the candle range high and the candle range low. When we analyze it closely, we see that the candle range low was broken by the following candle, which immediately reversed upward after taking out the previous candle's low. Just like in the prior example, this strong movement leaves behind an inefficiency in price. In other words, the chart remains inefficient at these levels, and price will eventually look to rebalance that area. And as we already know, inefficiencies tend to get filled. In this scenario, that implies price will eventually seek higher levels. This becomes an excellent confluence when we also consider that there is an untouched candle range high, which smart money may look to use for liquidation after having already taken liquidity from the candle range low. With that in mind, let's zoom in further to better observe the price action within this zone and refine our entries on the 15-minute time frame. If we focus on the final candle before the last impulsive move and mark it as a demand zone, we can place a long buy order at that demand area. The stop loss can be set below the demand or beneath the most recent swing lows. In this particular case, I prefer placing the stop below the last swing low, since the demand zone itself is quite small and may not be strong enough to justify a tight stop. Because of this, we are aiming for more of a swing-style trade that can last a bit longer. If we set the take profit just above the candle range high, the risk-to-reward ratio becomes relatively small due to the wider stop loss. However, this is not an issue, as we can instead target the swing highs, expecting a bullish break of structure in line with the ongoing uptrend, which offers a solid 1-to-3 risk-to-reward ratio. Now let's let price play out. And there it is. Price even continued higher, which would have allowed for an even greater risk-to-reward outcome. But we cannot predict the future with that level of precision. A 1-to-3 ratio is more than sufficient. Additionally, this position required holding through multiple candles. If we examine the chart closely, we can actually identify additional trading opportunities. And yes, there is another one, a fair value gap that formed shortly after the demand zone. This highlights the advantage of truly understanding market structure. There are often multiple setups available, not just a single one, but recognizing them requires a well-trained eye. One of the most common issues I see traders struggle with when using the CRT model is identifying the correct CRT main candle. A practical way to reduce this problem is to respect the time windows mentioned earlier and wait for those periods that produce an aggressive candle on the 4-hour chart. In this example, we go straight to the key point. If we move our focus to this specific candle, we can see that it printed at 1 a.m., which is a significant time. At this stage, we mark both the candle range high and the candle range low. It is also essential to analyze key levels and points of interest, as this is what makes market analysis using the candle range theory truly effective. On this chart, the most recent point of interest is a supply zone. A supply zone is defined as the last candle before a strong impulse, and we can see that the CRT main candle has fully filled this supply zone. This tells us that the market now carries a bearish bias. The following candle wicks above the high of the previous candle, taking its liquidity, and then immediately reverses to the downside, breaking the candle range low after first breaking the candle range high. One way to trade this scenario is to zoom into a lower time frame, such as the 15-minute chart. Since the supply zone is relatively small compared to the overall range, and after price completes its liquidity sweep and reverses downward, we look for setup models once a downtrend begins to form. A straightforward and effective approach here would be entering a short sell position after the upside liquidity sweep, once a candle drives aggressively to the downside and maintains bearish momentum. The stop loss can be placed above the higher time frame supply zone, while the take profit is set below the candle range low, since price initially manipulated and broke above the candle range high. From there, we simply target the candle range low. To summarize and ensure everything is clear, the CRT main candle can be identified on many different time frames. However, from my experience, the easiest and most practical one to spot and trade is the CRT candle on the 4-hour chart. We start by identifying the CRT main candle that prints during the specific hours mentioned earlier, which are typically the times when an aggressive candle forms. This candle becomes our CRT main candle. From it, we mark both the candle range high and the candle range low, then wait for the candles that follow to break one side of that range first, either the high or the low. In this example, the candle range low was the first level to be broken. After that, we move down from the 4-hour time frame to the 15-minute time frame. This process can also be applied using the 30-minute chart. However, as I mentioned before, I personally found the 4-hour to 15-minute combination to be the most effective. That doesn't mean this pairing is objectively the best, but it is the one that has produced the most consistent results for me. You are free to experiment with different time frame combinations, and, if you'd like, share in the comments how you structure your own trading plan. With that said, once we switch to the 15-minute chart, and considering our expectation for price to move toward the candle range highs, we begin looking for entry models that align with a bullish scenario. The price action we are analyzing includes both the 4-hour structure and the 15-minute structure. The 4-hour CRT candle and its zone are marked by the purple area, while the 15-minute price action is highlighted within the yellow zone. We can also clearly see the initial break of the candle range low. Since our objective is to target the candle range high as the next liquidity level, we focus on entry setups that support upward continuation. By zooming further into the 15-minute time frame, we can identify a bullish fair value gap. At this point, we have two possible positional entry strategies. The first approach is to place a long buy order at the top of the fair value gap, with a stop loss positioned below the fair value gap and a take profit set above the candle range high. This setup assumes that price will respect the fair value gap and not trade below it, which makes it the riskier option. That said, I have personally found strong results using this method. The second positional approach uses the same entry at the top of the fair value gap, but this time the stop loss is placed below the candle range low. With this setup, you are assuming that price will not break the candle range low before it breaks the candle range high. This second option generally has a higher win rate due to its lower risk to reward ratio. I usually take this type of trade only when I have additional confirmation from the higher time frame. For example, if there is a clear key level where price is likely to react, I will set the take profit near that level, which can significantly improve the risk to reward profile. And that brings us to the end of this explanation. When applied correctly, this strategy can be extremely powerful. However, to use the CRT model effectively, you must develop a strong understanding of price action, market structure, and liquidity.